You've heard it all before on the news and TV: net worth, asset allocation, rebalancing, portfolios. It's all important and you sort of understand it, but in the sea of financial lingo, what does it really mean? My name is Tristan Jacoby and I'm a financial advisor here at Creative Wealth Management in Ocean Pines, Maryland, and I'm here to help you when talking finance. Net worth. Net worth is often used as an important surface level metric to gauge financial health. It is the assets owned minus the liabilities owed. Assets are anything owned that has monetary value, while liabilities are obligations that will deplete those assets. In business, net worth is often defined as shareholders' equity. Mike and Jill have the following assets: a primary residence valued at $350,000, joint non-IRA valued at $225,000, and a joint checking account valued at $125,000. Their liabilities include a $180,000 mortgage, an auto loan of $20,000, and credit card debt of $5,000. What is their net worth? The answer is a positive net worth of $495,000. We get there by subtracting liabilities from assets. Mike and Jill's total assets combined for $700,000. This is comprised of the primary residence, the joint non-IRA, and the checking account. We're going to go ahead and then subtract their liabilities, which includes the mortgage, the auto loan, and the credit card debt. To this, we get a positive answer of $495,000. Asset allocation. A strategy used in investing that aims to balance risk and reward by allocating a portfolio with stocks, bonds, and cash or cash equivalents based on an individual's risk tolerance, time horizon, and life goals. Hypothetically, a younger, more aggressive investor's asset allocation may include a higher percentage of stocks, while an older, more conservative investor's asset allocation may use a higher percentage of bonds or cash equivalents. Investors may use different asset allocations for different goals. Used in conjunction with asset allocation is modern portfolio theory, which intends to maximize return given a certain level of risk or minimize risk given a certain level of expected return. Don, age 60, wishes to retire in 5 years. Investment assets include an IRA worth $500,000 and a non-IRA worth $45,000. Don wants to use his IRA assets to supplement his retirement income and wishes to eventually pass his non-IRA onto his grandson upon his passing. For Don's IRA, he has chosen an asset allocation that's main focus is preservation. He will have a higher percentage of his allocation invested in bonds or cash as he nears retirement. Reducing risk is a key goal for this account since Don is approaching retirement and he will need this account to last for the remainder of his life. Don specifically wishes to pass his non-IRA to his grandson upon his passing. Since Don is not intending to spend these funds in the near future, growth would probably be the focal point, and it may have a higher percentage of stocks in the asset allocation than his IRA would. Rebalancing. Rebalancing is the process of resetting a portfolio back to its intended asset allocation in order to maintain a desired level of risk exposure. This process involves the selling off of gains from stocks and banking them into bonds or cash if the portfolios become too heavy in stock weighting. On the flip side, if the portfolio's stock weighting is dipped below the target level, funds from the bonds and cash will be used to buy stocks until target levels are reached. While rebalancing does not prevent market loss, it does help safeguard investors from taking an undesirable amount of risk given their individual risk tolerance levels and may allow them to take advantage of potential drops in stock prices. Jackie is 41 years old and has a 401k valued at $355,000. She wishes to retire by 60 and considers herself a moderately aggressive investor. She has chosen an asset allocation that is invested in 60% stocks and 40% bonds as of January 1st. She has rebalancing set to automatically occur at the end of each quarter. At the end of the first quarter, her asset allocation is now 65% in stocks and 35% in bonds. How will her upcoming rebalance adjust her portfolio? Since Jackie's stocks have risen in value through the first quarter, increased from 60 to 65%, her portfolio will sell off 5% of those stocks and invest the proceeds back into her bonds, bringing her back down to the intended 60-40 asset allocation that fits her risk tolerance. Mutual fund. A mutual fund is a pool of funds from many investors that is professionally managed and invests in various securities such as stocks, bonds, and other financial instruments. Each mutual fund's portfolio is invested based on the objectives outlined in its prospectus. Investors purchase a share or unit of the mutual fund and therefore own that portion, just like if an investor were to purchase an individual stock and own that piece of the company. Joan, age 28, wishes to start investing, but doesn't have a huge amount of resources and doesn't have enough time to research individual stocks. She's looking to grow what she invests long term and is not concerned about potential market dips in the short term. She finds XYZ large cap fund. She realizes that this is the fund for her. She buys 10 shares at $10 per share for $100 total. Joan's investment will be pooled with many others who have invested and will be used to purchase hundreds of stocks that meet the parameters outlined in the prospectus of XYZ large cap fund. Managed account. Professionally handled account that uses a designated amount of an individual's funds and is invested according to an outlined strategy. A managed account is different than a mutual fund in that the individual investor actually owns the specific holdings within the account rather than owning a share or portion of the fund as a whole. Minimum investments are common for managed accounts, which can make them more difficult to access for the average investor. Bobby, age 54, has used mutual funds to invest for the majority of his adult life. He has grown a considerable net worth of $5 million and now has the ability to access certain investments he previously was unable to. Bobby loves to follow the market and has a keen interest in small cap stocks in particular. He has $100,000 that he would like to invest specifically in small cap stocks, and his advisor suggests ABC managers as they specialize in managing small cap portfolios. Bobby then invests his $100,000 with ABC managers and for an annual fee has entrusted them to make the individual buys and sells of small cap stocks for his account. Bobby now has the ability to see all of those individual small cap stocks he owns, and no other individual can contribute funds to his account. Well, that about wraps things up. If you've enjoyed our video and want to see more content like this, drop us a like or share and follow us on Facebook. Once again, my name is Tristan Jacoby. I'm a financial advisor with Creative Wealth Management, and I'll see you next time.